Nvidia lost $130 billion of market value in a single day. Not on bad earnings, not on a failed chip, on the announcement of a $500 billion deal. 6 of the biggest names in finance are teaming up with Nvidia to fund AI infrastructure. That should have been a victory lap. Instead, the stock fell because the market recognized the playbook. The last companies that ran it were the giants of 1999. Neither exists today. Here is the shape of it. First, what Nvidia actually announced. Second, why the market read it as a warning instead of a win. Third, the test that starts tonight when the first leveraged AI cloud reports earnings. The names in the deal matter. Apollo, BlackRock, Blackstone, Brookfield, Goldman Sachs, KKR, $500 billion of third-party capital organized by the company that sells the chips the capital will buy. Jensen Huang said the quiet part in the press release. In AI, compute is revenue. Hold on to that sentence. It is either the thesis of the decade or the epitaph of the cycle. First, the deal. Nvidia is setting up independent financing platforms with those 6 firms to mobilize over $500 billion for AI factories and data centers. The capital funds Nvidia's customers, frontier labs, enterprises, AI cloud providers. They borrow at attractive rates, and they spend the borrowed money largely on Nvidia hardware. Nvidia contributes its technology as the investable asset. Larry Fink called it deepening the relationship. Blackstone's John Gray said they are already enormous investors across the Nvidia ecosystem. Every word of that is true. That is exactly the concern. Second, the reaction. The stock dropped 2.4% to around $218, briefly down 3%, wiping out $130 billion in value. Here is why. When the seller of a product arranges financing for the buyers of that product, reported demand and real demand start to blur. There is a name for this: vendor financing. Lucent and Nortel used it to inflate the telecom boom in 1999. Customers bought equipment with the manufacturer's own money. Revenue looked unstoppable until the borrowers could not pay, and the revenue turned out to be a loan the whole time. The market did not sell Nvidia because the deal is small. It sold because the deal implies demand may need help. Third, the test starts tonight. CoreWeave, the most leveraged pure-play AI cloud on the market, reports earnings after the close, with Supermicro alongside and Applied Materials later this week. CoreWeave is exactly the kind of borrower this $500 billion is built for. Heavy debt, rented GPS, revenue growing fast, margins under pressure. Tonight we find out whether the borrowed money is producing profits or just producing capacity. So the setup is this. The biggest chip maker on earth just told you compute is revenue. Tonight, the market checks whether revenue is profit. What this means for your money, not advice, just the mechanics. If you hold Nvidia or the index funds where Nvidia is a giant weight, which is most retirement accounts, the question has changed. It is no longer how fast can AI grow. It is how much of that growth is self-financed. Watch one split from here. Cash-funded spending, like Microsoft and Google building from their own operations, is real demand. Debt-funded spending, arranged by the chip seller, is demand on layaway. Both buy chips today. Only one keeps buying when credit tightens. And notice who cannot lose. The 6 financiers collect fees on the way in, hold claims secured by real GPUs and real estate, and if it sours, they are the creditors, not the shareholders. The people who built the casino did not bet on the games, they financed the players. So here's the question. If AI demand is as strong as every keynote says, why does it suddenly need $500 billion of arranged financing? Tell me what you think in the comments. The blue pill says, this is infrastructure finance growing up. Railroads, telecoms, and power grids all needed structured capital, and AI is no different. The red pill says strong demand funds itself, and the moment the seller starts financing the buyers, the cycle has begun marking its own homework. In 1999, that answer took 2 years to arrive. Tonight's earnings are the first page. The timeline keeps moving. We will see you in the next one.